So I'm super excited for this panel. We have two amazing legends. So first I'd like to call up Bryce Johnson from Vesting. I don't know if you guys ever seen Bryce's content online. I encourage you to check it out. If not, he's covering everything from startups to investors and everything in between. It's called Vesting. And then the absolute legend, Ling, 19 unicorns, previous GP at Coastla. Can't wait to hear this panel.
What's up,
so
man?
give it up for Bryce and Ben.
I was going to put you in the middle, man.
What's that?
I was going to put you in the middle.
That's fine.
No, man, I appreciate you having me up here first. First off, it's a good crowd. I'm not going to lie. I know the Miami venture scene has been trying to come up. I've been here for about 5 years, and it's dope to be a part of the scene. Dope to chat with you. Justice hit me up and was like, yo, you got to chat with this guy. 19 unicorns, early stage, investing, GP at Coastla, GP at Bling Capital. I got to start this off, man. 19 unicorns. What are some things that you've seen from these various different founders that you've invested in the early stages that are like some characteristics that you find yourself coming back to as you're analyzing the horde of AI slop out here and trying to find the diamonds in the rough?
That's a very frequently asked question. So I've invested through the internet cycle, the mobile cycle, and now the AI cycle. So I think ultimately it's the same characteristics around founders that we back.
Yeah.
So the first is mentally tough and resilient. So, and also number two is high IQ, high EQ. The ability to be extremely stubborn, but not too stubborn to take good feedback when they hear it. Number four is, are they a learn-it-all versus a know-it-all? Meaning that you can learn everything very quickly and become an expert very quickly versus assuming that you already know everything. And the fifth, which is really important, is the charisma factor, is do they have it? Can you sell to investors? Can you sell to customers? Can you sell to partners? Can you sell to employees? All sometimes without having anything. And the ability to do that is we call the reality distortion field. And when you have the reality distortion field, you get a lot of forward credit from the investors, which means you can raise more money, which means that you can actually execute against your vision. So those are the main characteristics that we have always invested on for the last, 15, 16, 17 years now.
When you think about kind of this, you talked about the ability to sell to investors, but also you need to balance that aspect of you have the high level vision of what this company can become, and it has to be a multi-billion-dollar vision at this standpoint. When you're looking at kind of how things have changed in seed rounds from 2018 to now, we're looking at valuations that are like 3, 5, and sometimes 10x what they used to be. What are your thoughts on that?
It depends, yeah. It depends.
What are your thoughts on these valuations, and how do you decide what is considered fair value for your dollars?
Ultimately, in the pre-seed and seed rounds, I think what you're focused on should be what is the amount of money that I need to raise to reach the next material de-risking point. And it's less focused on valuation. As long as it's a fair trade in terms of I'm raising $3 million for X percent, whether the X percent is 10 or 20, it's totally reasonable as long as you have the ability to reach your next milestones. And I think actually focusing on the right partner is far more important than maximizing valuation. You can maximize valuation in your first round, but all it causes is it's an additional hurdle to reach for the following round. So put differently, if you were put in the 12th grade when you were in the 6th grade, you're expected to perform at least the 12th grade, and you have to know all the concepts, et cetera, and be ready for graduation into college. But if you're not ready for that, it's a big, wake-up call. And then you end up getting really punished. And then you get squished down, and then it's just sort of it's not a great experience. So maximizing valuation, we never recommend that founders maximize valuation in the early stages. So in the early stages, in particular, you're choosing a partner that's going to be around with you for 7 years, 10 years. And so ultimately, you're choosing a team. It's the same thing as finding a co-founder that you can't fire. Yeah. Like they're literally on your cap table for 7, 10, 15, 20 years. So you want to choose carefully. You want to choose people that can really inflect the value of your business. Sometimes you don't have a choice. Sometimes you only have one offer. That's what it is. But when you do have choices, you do want to optimize for the people that can actually inflect the value of your business, either through A, operating experience, B, a really broad network that can connect you to customers and partners, or C, a very broad network that can lead you to your follow-on investors. right? So there's these different things that investors can bring you. And some investors will say, oh, we give you a check and we don't do anything. Like Founders Fund famously says we just back the founders. But that's not just, it's not really true. They don't just do that. They have a very, very deep network across the entire industry. And so they actually have a ton of value add, even though they may say we take a more hands-off approach.
Now you talk about network and the importance of the various different funds. Some are more hands-off, some are more like, hey, we're willing to help you through the tough and the bad times. I've had my own VC experience when I previously raised money in my company and we were in the down moment and it was the complete opposite. But when you look at kind of your work and trying to get in the more high quality sought after funding rounds at the earlier stages, how much of that is you having to sell yourself and win the deal at this point versus when you first started?
It's always a combination of both. So the job as a venture investor is the combination of one, vetting, and then also two, selling, right? Because the best founders oftentimes have many, many options, so you've got to be able to sell at the same time. And so it's a combination of a vet and a sell. What we try to focus on, there's two sets of founders that we focus on. One is the first-time founder, and we call those like undiscovered gems. And the ability to actually for us to discover those undiscovered gems gives us what we call alpha. So we actually have more, like, it increases our investment returns, because when somebody is a known operator and very, very successful, then they're going to get market price, and there can be 7 bidders or 10 bidders or 15 bidders, and so it's going to be, the price is going to be very inflated. But if you're new, if you're a first-time entrepreneur and not yet known, we love to discover them and then work with them on refining and revealing the gem that they are. So that's the first set. The second set is a repeat entrepreneur that's made money for us before or for their other investors, and that's just much more sort of a proven, those are not undiscovered gems. Those are probably like known gems. And sometimes those known gems are less well known, because if a company that you, like for example, if an entrepreneur started a company and they sold the company for 80 million, 100 million, they made a lot of money, but they're not famous in terms of all the, everybody knows who they are. So oftentimes they will get, a different valuation. And there's a third bucket, which is, people that are well known, very well established, senior executives that are, you Google Trends, you see them on Google Trends. And those people typically will get a different valuation.
So I have a hot take around how VCs, and you talk about the first-time founders, but I have a hot take around the idea that there are select VCs that we would consider sheep, and those are the folks who are just checks that follow. Yeah. Hey, it sounds like you also have this take where it's like you have the shepherds and then you have the sheep. So where do you fit, and how often do you find yourself writing the first check versus?
Almost always. Almost always. And we take a speed matters approach, meaning that it's important to make decisions relatively quickly. So in various meetings, there have been, historically, up until I had a team, I would make a decision oftentimes in the first meeting. And sometimes you can tell within the first 5 or 10 minutes whether you want to invest in a founder. And because in the earliest stages, in the pre-seed stage, it's really two things, right? Number one, the quality of the founder. And then number two, the size of the market that they're playing in. Because the size of the market is a thing that's a little bit harder for even great founders to be able to change. If the market's too small, you're just swimming in a small pond and you just really can't get out of it. So we find ourselves, we prefer to lead, and we lead probably 90% of our investments.
When you look at that 10-minute call you have with the founder and you're trying to due diligence.
Well, usually it's 60 minutes, but you can sometimes tell in the beginning.
Oh, like that first 10, and then you just kind of, for the rest of the time, you're just doing it to be polite or whatever. But when you think about that first call, what are you looking for? How does a founder need to approach you on the first call? Is it the tone? Is it the voice? Is it the confidence? Is it a combination of things for you to be like, you know what, I think this is somebody that I would want to put money behind?
It's all of those things that I mentioned earlier. And I think one of the things that many VCs will say is that a pitch for the VC is a psychographic evaluation of the founder. And they're trying to understand who you are and how you operate, how tough you are, how you think about things. Can you reason through problems? Can you face adversity? And so there's times when I think investors will challenge entrepreneurs, even on things that are correct, just to watch the reaction and to see how that sort of all plays out. And some people do it very gently, and some people do it more roughly. And I think it really depends on the specific investor and the founder dynamic, and to start trying to understand that. So I think when raising money, I think it's important to understand it's not just a pitch, it's actually they're trying to understand who you are.
Do you think having a good understanding of the motivations of a specific founder is important on that first call?
Generally, yes, but it is very hard to tell. It's very, very hard to tell because, everyone says we prefer to back missionaries rather than mercenaries because the mercenaries will give up or will sell early because if they make 20 million, 30 million, they'll sell, right? Which is great for the founders, but not great for the venture funds because the venture math is essentially most funds will have somewhere between 20 to 40 companies, and they need one of those companies to return the entire fund. So be a $1 billion company or more than a $1 billion company. And so a $100 million exit really doesn't move the needle for the venture funds, but obviously is extremely great for many founders. But I think that sometimes it's obvious, but oftentimes it's not obvious at all, right? Because founders know they should say, like, I'm in this for the long haul, this is my life's work, like, et cetera, et cetera. Like these phrases that everyone's been trained to say.
When you look at kind of how social media has now started to play a role in the founder dynamics, there was, the concept of the launch video that got really popular probably the last 6 to 8 months. How much of social media founder creator dynamics are a facade versus how much of it do you think actually matters when making a decision on a founder?
It matters, but not as much as I think people think. For us, it matters because to get to 0 to 1 is oftentimes highly unpredictable and somewhat magical. So in the previous panel, it was asked, like, what did you have to do to find product market fit? There is no formula. Like, if there was a formula, then everybody would be doing it, and would not be, like, building companies would be very, very straightforward, right? There would not be risk associated with it. But having some sort of unfair advantage in the 0 to 1 and the 1 to 10 and the 10 to 100 and the 100 to a billion is important. And having an unfair advantage in terms of distribution, if you have a very wide distribution outlet, whether it be social or anything else, can be a real advantage. I think, though, most investors are wise, that a social distribution strategy can work, but you have to look at the engagement. It's the same thing as when you see people saying, I have, this many registered users. I have 1 million registered users. Well, how many of them used your product in the last week? 7 or 900,000? It's very different, right? Those are very different things. And it's the same thing, like from a social distribution standpoint. It's what is the engagement that you're receiving on each one of your posts and what's the number of views, so on and so forth. Yeah.
Now to switch gears to the other side of it, being a GP and dealing with LP relationships and building out a fund, we're starting to see that kind of same dynamic where more VCs are trying to take the Harry Stebbings 20 VC approach to getting their first checks in for their own funds. How much of it matters to you in terms of content, in terms of how you build out Bling, or do you feel like it is also a bit overrated to take the content-specific approach?
No, I think it's important, and I think we don't do as good of a job as we should. And we actually got some feedback from one of our LPs that, hey, you should probably do a little bit more like press and PR. Yeah. We have about $1 billion under management, and what I would say is the way that we source deals or source companies is different, I think, than most others. So for a little bit about our fund, we are focused on product market fit, because the hardest thing in seed is finding product market fit. So what we have is we have over 100 executives who are the heads of product, heads of growth, heads of engineering, heads of sales, CEOs, et cetera, who are all invested in our fund. So when the fund's invested in your company, all of them are invested in your company as well. And the company gets direct access to them for help, mentorship, advisorship, so on and so forth. So that's one of our sort of secret weapons, where we have essentially spies throughout the industry who will refer to us companies because the favor, quote unquote, that they're doing for us is they invest a small amount of money in the fund. But then going forward, they're just acting in their own financial interests. Because if you're a director of engineering at an up-and-coming company and one of your reports says, I'm starting a company, who should we talk to? We want you to say, well, I don't know, like I'm invested in Bling Capital and also these 2 others. And then it's our job to move very quickly to run the evaluation process. So it's important. I think for VCs for people that are starting their own funds, if you have an established track record, if you had an operating history, because previously I was an executive at Google, YouTube, and Facebook. I started all of Google's commerce group. I used to run Facebook platform. I ran YouTube's platform, and I ran search products at Google. And then so I was investing during that period of time. So I already had, I had a pretty really broad network along with a bunch of companies that I invested in also. So my approach has been different and less PR focused and more network focused.
Because your background is so unique and you've been able to kind of see the progression of the internet and products on the internet as well, when you look at the balance of OpenAI and Anthropic, and we've seen more recently where Anthropic released Claude Design and they're looking to, prospectively eat Figma. How do you go about deciding what is considered good product being built by great founders in an era where you do have these large language model companies that are looking to bite and chew off anything they see spending an absurd amount of tokens on their platform?
This question has always been asked through every single cycle of computing, ranging from Microsoft to Google to OpenAI, right? And so you're sort of thinking through this. And I think the answer is that as an investor, we have looked for specific things that are big, but not too big. And there's sort of a wedge that you can conquer that will make you potentially a billion or $10 billion company that's non-obvious, that can make you, once you're in that position, you have more strategic high ground. It's hard to discover, but that's generally our approach, because if it's obviously hundreds of billions of revenue, it means the large platforms are always going to go after it. The large foundational companies, the large platform companies, because it's enough, right? But if it's not $100 billion in revenue, and if it's potentially only $1 billion in revenue, then usually those markets are safe. They're safe in the near term, right?
When you look at the markets of where we're seeing successful founders building out of, everyone knows SF is an insane market. Miami is now starting to kind of get some traction. I don't think it's close to SF yet. But when you think about kind of what you've seen in your career and the characteristics that make these markets grow, what does Miami really need to start being a major player in the venture space in the AI front, right? Is it companies coming in and bringing more employees and talent, so building out of here is exceptional? Like, what do you think?
I think it's three main things. I think the first is that we need a $10 billion company. Typically, a $10 billion company means it has 100 directors or so, and if you have 100 executives, that's very helpful to the ecosystem, because that means those people can shard off and join or start other companies. I think the second thing is that we need an extremely, this is less important, I think, because of the advent of AI, but I do think a K through 12 education is particularly very, very good K through 12 schools, because typically people that are who are executives and even employees at companies that are in their 25 to 40 age range oftentimes have kids, and those people usually care about their kids' education. And then the third, historically, has been that there are great universities that print new grads. And so there's an argument that we need fewer new grads now than ever before, but I still think it makes a big difference having the ability to have fresh talent available that wants to work 18 hours a day, right, at your company. So I think we need some of that, and some of that might need some time. So I had the same conversation with Peter, I think in 2008 or something like that, about LA and New York, and I think New York is kind of there, and LA is kind of there, right? So with Snapchat and the others, but I think it does take time, and it doesn't happen over 2 years. I think it happens over a decade.
I think you're right. I think we're at this point where there's a lot of good energy, but it's years and years of consistency within that energy to get to a point where the venture scene is super robust. When you think about kind of what the next generation of companies look like and how that aligns with some of the more recent companies you funded, what are some areas that are super interesting to you, things that are compelling within these sectors of AI that feel non-obvious but have a chance to create winners?
So I get this question a lot in terms of what's interesting to me. And what I would say is that from a fund perspective, because we're pre-seed and seed, we are very open-minded.
Yeah.
We're very open-minded about great founders playing in a non-obvious market or an obvious market, and then that's how we decide. So, you'll hear a lot of investors say that, oh, I knew all along that company X was going to be a phenomenal company. But from my experience, like 95 to 99% of them are lying. They're just trying to make themselves sound smart. They literally are just making themselves sound smart. I won't name, this is, I think, being recorded in public, so I will not provide examples. But I know many examples that I've seen where a partnership votes no on an investment. Like basically everyone votes no except for one GP, and then later the whole partnership is later the company's a $10 billion, $100 billion company, and then the partnership is like, oh, we knew all along that this was going to be a great company. So so because it's easy to say that, because there's very few people in that room that remember that you voted no. But so this is a long way of saying I don't know. We are very opportunistic in terms of great founder, interesting large markets, and then we will invest in about 40 companies per fund. And when I look back on the investments, I would have no ability to tell you at the moment in time that this one would be a $100 billion company and this one wouldn't make it. Because obviously you're at that moment in time, you're like, this one's gonna be great, this one's gonna be great, right? So it's pretty hard to tell. But usually you can start telling within 12, 24, 36 months, but even still, that's not true, because there's companies that do this and then do this, right? And some of those continue to do this, and some of them can do this. So you have the right and the wrong and the wrong and the right also in terms of a lot of companies.
It's funny that you're being humble as somebody who you have 19 unicorns, and you're like, hey, even I don't know. But what I do want to know is, when you look at a company you've invested in and you're trying to decide whether to write a follow-on check or not, what normally goes into that decision making beyond just metrics?
So there's actually pretty deep analysis that we do in terms of writing a follow-on check. One of the things that we do, which used to be standard and now feels like venture investors oftentimes don't do it, and I don't understand why, is what was called cohort analysis. And you just literally look at the customers and users from the month that they started and see whether they retain with you over time. Did that make sense? Because some people are like, oh, we're growing 3x year over year. But if all of your customers churn and they're all churning away, meaning that the customers you got in January are gone by June, that means in order to grow 3x year over year, you've got to get a whole new set of customers, which means usually you're paying a ton in customer acquisition costs, right? So there's the cohort analysis and also standard payback analysis, which is, well, if you're spending $1,000 or $10,000 a month on marketing or $100,000 on marketing, which month do you get your money back? Are you getting your money back? Because a lot of times the companies are not getting their money back, and they don't even understand that they're not getting their money back. It's okay to say, we currently don't have good payback because our margins are bad, but here's how our margins will get better over time. And in the future, this is what our payback looks like. But for us, it's not great to say, well, we didn't know that our margins are bad and we didn't know our payback was bad, because it kind of means that you don't really fully grasp the business you're navigating.
Well, I think I might have time to get one more question out of you, so I want to make it a good one. When you look at kind of the landscape of how AI is continuing to revolutionize venture and how your firm continues to balance AI companies but also using AI internally, have you guys looked into finding ways to get an edge through using AI on a regular basis, and how?
It's certainly possible to use AI to get an edge, and so a lot of firms have used, for example, LinkedIn and trying to analyze when people's LinkedIns change, so then that way they can reach out to them. We have not taken that approach as strongly. We really have counted on, people and the networks, because I do think that is enduring in AI. I think one of the things people ask is well, what type of jobs are going to be available and interesting, or are they're going to pay? And I think the answer is that things that are uniquely human. And so things that are uniquely human and not easily replicable by robots or AI will actually be very valuable. So I think that there'll be a flip in terms of the type of value we put on a variety of services provided by humans.
Well, damn, that was fire. Appreciate you giving me 30 minutes.
Yeah. Thanks.
Do we have time for Q&A or like? Yeah, do it.
Hi, sir.
Okay.
Like you have invested in so many founders. What's like looking at so many people, early stage founders, there are different characteristics that define success, right? But what are the key characteristics that you look at in a founder that you definitely know that they are going to fail in that case? Like thinking in terms of inversion principle here and thinking that like looking at so many companies, what's the early signs, what are the early things that you see that you can definitely tell that this is going in the wrong direction?
The question is, what are the characteristics in a founder that lead an investor or me to believe that they will definitely fail? And I think that it's a good question, but I don't think investors know that. I mean, I think it's overly confident to say that, oh, this company is going to fail, because you don't know, right? But I do think the inverse of what I said earlier, for example, if they are so confident that they are correct and know everything, that usually does not lead to a very successful company, because people generally don't want to work with this person who's a know-it-all versus a learn-it-all. And if they're not really mentally tough and resilient, it is hard for them to go through all of the lumps, right? So obviously investors will get it wrong. They get it wrong most of the time, actually, because if you look at the return profiles of companies that are successful versus are not, in the seed and pre-seed stages, it's like 90% of companies don't make it, right? So it means that they're wrong the majority of the time. But when you're right, you have to be really, really right. And so I don't have a really great answer for you, because there's not a single I mean, there's many disqualifying characteristics, but doesn't mean that those are the right answers. Does that make sense?
So basically you don't discount like the person out completely out of the picture. Just by the
Well, it doesn't, sorry, you asked, we don't discount. Well, we obviously do. Like if I think that the person doesn't have charisma and can't sell to customers, can't sell to employees, can't sell to investors, we're not going to invest. But that doesn't mean that I'm right. That's what I'm saying. Okay, so there's disqualifying, every firm has different disqualifying characteristics, but it doesn't mean that they're right.
Ben, Bryce, thanks for hopping on. I had a quick
Hey,
question.
Bryce.
So there's a common trend that's everyone talking about, that vertical SaaS is dying. However, horizontal SaaS is here to stay. I would love to see your take on this. What are your thoughts if you agree with the statement?
I think everybody heard the question. I would say that's a little too generic of a statement. I think ultimately it depends on switching costs and defensibility. Ultimately, if something has a lot of lock-in, either because of network effects or integrations or people's workflows that they're just so stuck in it, if it's a high switching cost, typically it means you have defensibility of some sort. And if it's not, then yeah, then I would agree. So I think it's a little bit more nuanced than just that, because if you look at Salesforce, one would argue that's a vertical SaaS, but it's a platform, right? But I think Salesforce does have durability because of all the integrations and all of the lock-in, so on and so forth. So they're going to last a lot longer than some of the smaller companies. So I would say that's too generic, but it definitely, generally, is true.
We have time for one more. One more good one.
Thanks. I'll riff on his question a little bit. Could you speak to how you feel that the legacy SaaS companies like Salesforce or ServiceNow or SAP even, how do you think that they will fare in the face of upstarts with multi-agent capabilities that can be maybe move faster? Or do you think that their lock-in and their capture of AI will keep them alive and allow them to be successful?
I think the answer here is that number one, it usually takes a very, very long time for the upstarts to reach any degree of scale that actually threatens those large $100 billion companies. Because by definition, they probably are doing $10 billion or more in revenue for the $100 billion type of valuation. And it takes a long time to get to $10 billion in revenue, usually, right? Unless you are OpenAI or Anthropic, or like some of these other companies that have, there's few of them. So I think it takes time, and usually, historically, we have seen these large incumbent players figure out something, like something else out, right? Because if you look at Oracle, well, people were really worried about Microsoft and thought Microsoft was quote unquote over in the internet, in the internet age, but Microsoft's not over. Microsoft's one of the most valuable companies in the world, right? People thought Oracle was over, but Oracle is not over, right? So I think, and if you look, you can repeat this through, there was Micron, and you look at the hardware companies, right? Broadcom, Micron, like these companies, you thought, oh, those are over, but they're not over. And so I think the answer is that it's not obvious. And ultimately, these companies have to figure out their new business model and their Act 3 or Act 4 or Act 5, in the new environment. So I don't think it's a foregone conclusion one way or another, because usually they have massive amounts of cash and they can acquire their way into things, or they can build things. Usually acquiring is a little bit easier, but that's kind of how I think about it. Yeah.
Amazing. Give it up for Ben and Bryce.
Thanks, guys.